Okay. So, apart from the National Housing Fund contributions, you have the Police Fund levy, although it's still a subject of litigation as to its applicability. Depending when the Supreme Court decides otherwise, the Police Fund levy, portion to the Police Act, still remains part of our tax laws. Then you have the payroll contribution under the Employee Compensation Act. Okay, it's a tax. Then you have property taxes by state governments. Specifically, you have land use charge. That's the most common form of property taxes by state government. It's a type of tax. And last but not the least, you have the Nigerian Content Development Act levy on all oil and gas contracts. Okay, that levy is a tax under the Nigerian Content Development Act. Right. So now coming to the first one, which is withholding tax. Withholding tax is a tax that comprises of or is provided for under the Personal Income Tax Act as amended 2011, which comprises or states or is to the effect that or places an obligation on an individual who is lawfully obliged to pay certain sums of money to another individual to deduct a percentage of that sum that he is to pay as taxes to the government and to remit him to the appropriate tax authority. That is basically what withholding tax is. An obligation placed on an individual who is duty bound to pay some certain monies, who is legally bound to pay certain monies to another individual, to deduct a percentage of that monies to be paid as taxes to the government, and with an obligation to remit same to the government. Now, a key thing about withholding tax is that it is a tax that is, or a taxation system or a taxation process that is designed to help the government collect personal income tax. That is one unique thing about withholding tax as against or separate and distinct from other types of tax. Right? It's a tax system. Withholding tax in itself is not a tax in terms of, it's not a full tax on its own. It's a tax created to help the government collect personal income tax. Now, the reason for that is obvious. You know, tax generally consists of an obligation placed on individuals or corporate bodies and all that to pay certain amounts designated by the government as tax. Now, in reality, of course, we know that the average individual is not always, in a hurry to part with his money. And so payment of tax is not as easy as you might expect or think. And so one of the ways, formulated by the government to make it easier to collect that income tax is to collect it at the stage where that person who would ordinarily be due to pay income tax is about to receive money. All right. So if a person liable to pay income tax is to receive money on certain kinds of transactions, for those transactions, the withholding tax says that the person who is to pay that money should deduct this income tax upfront and remit. Now, what does it imply? It implies that when it is time for that individual from whom this withholding tax was deducted, when it is time for that individual to pay income tax, all the withholding tax deducted from his income through this withholding tax system will be minus, will be removed from his assessment at the end of the year. So, for instance, if by ordinary assessment his personal income tax for a particular year is 2 million naira, if he has had 800,000 naira deducted from monies due to him, either under a contract, as dividends from as a shareholder, as royalties, as interest on a loan, whatever form in which these withholding tax have been deducted from him, those withholding tax deducted will be brought together. That 800,000 naira he has, I would say lost in terms of he has had deducted from his monies prior to the end of the financial year, will now be removed from his 2 million naira income tax obligation. And so he will now be only obligated to pay 1,200,000 at the end of that financial year. And so that's why we always advise. You see, many of us in a lot of our fee notes and our pay slips, we see withholding tax, we just squeeze it and throw it away. It's wrong. All right, you are supposed to compile all your withholding taxes, all sums deducted from you by withholding tax through any means, your fees, your any income due to you that you see there that withholding tax has been removed. You have an obligation to gather it together so that when it is time to pay your personal income tax, you can put forward to the tax authorities your record of withholding tax, so that the tax authorities will know that they have an obligation to deduct it. And also it will help to detect fraud too, because even though the law says that these monies should be deducted as withholding tax from your income and paid to the tax authorities, in practice most of the organizations deducting these sums do not remit these monies. So when you keep your record and when it is time to pay your income tax, you present your record of withholding taxes deducted from your income, you help the taxing authorities also track those sums, and so they can call on the offices of those organizations and bodies that deducted that withholding tax to pay what they deducted, and also be able to pursue them to recover the money, so that you don't just have monies deducted from you as withholding tax and then someone else is enjoying it while you are now battling to pay double taxation for sums that should help to reduce your income tax budget. All right. Now, the relevant sections that provide for withholding tax you will find in sections 69, 70, 71, 72, and 73 of the Personal Income Tax Act as amended 2011. Right. Those are the sections that provide for withholding tax. And what you will find in those sections is that it creates several types of transaction in which withholding tax will apply. Now, the first of those transactions where withholding tax will apply by the provisions of section 69(1) and 2 of the Personal Income Tax Act as amended 2011 is withholding tax on rent. All right. Now, when it comes to payment of rent, there are 5 types of tenants that must deduct 5 types of tenants that must deduct withholding tax from their rent before paying to the landlord. In other words, whatever it is they are to pay to their landlords, section 69(1) and 2 of the Personal Income Tax Act places an obligation on those tenants to remove 10% of the rent and remit to the taxing authority, to deduct 10% from that rent, remit same to the taxing authority while paying the balance to the landlord. All right. So when I say only 5 types of tenants have that obligation, it means that all tenants who do not fall under these 5 categories of persons or organizations have no such obligation. So if I finish mentioning, if you don't fall in this line, don't go and deduct your landlord's rent and say that he's withholding tax. The man will take it up with you. All right. Now, the first type of tenant that is under an obligation to remove 10% of his rent before paying the landlord the balance of the rent as withholding tax is a company. All right, a corporate client, a company. All right. Now, any company registered in Nigeria or recognized by any law in Nigeria to be a company is under an obligation to deduct 10% of his rent payable to his landlord and to remit same to the relevant tax authorities in that environment. The second type of tenant that has that obligation to deduct 10%